Not too long ago, traders, our team capitalized on the massive move that was the dollar rallying during the height of the pandemic back in February. If you guys go take a look at the channel back then, you'll see that we were mentioning that, hey, it seems as if market risk is increasing dramatically. What this is going to do is allocate more capital back over to the dollar, and that's exactly what we got. I'm hopping right into it, but it's for a reason. I want to show you guys here. If I pull out and I show you what we're looking like on our personal dollar index, what you'll notice is back during, again, end of February, you see a massive spike, early March, a massive spike in the dollar, only to see the dollar absolutely hemorrhage all of those gains in a matter of weeks. Okay, so now it's January. Okay, January 2021. Excited that everyone is, hopefully happy and healthy in the new year. Where are markets going now? Because we have just pretty much had the single largest dollar sell-off that we've seen since before 2008. I mean, we'd have to go back almost in history. This is one of the single largest dollar sell-offs from one point, a 52-week high, to a 52-week low, right? Usually people use that in the context of equities, but it's going to be important for us to use that in the context of the actual currency here, because the question is, how much lower can we go? Okay, so today, guys, what we're going to do a quick little fundamental dive on why the dollar is taking such a massive spill, and if there's anything left for this dollar, if there's any amount of value anywhere in the world where anyone says, hey, look, I want to buy the dollar, it's a safe haven currency, or its bonds yields are they're there, so on and so forth, or I just see general appreciation over the next few weeks, months, or years. Is there any market participant that wants to get involved in this? Right now, I don't see it, so it's setting us up for a pretty enormous opportunity if we play it the right way. All right, guys, what's up? Welcome back to the Kleveland channel. We like to do fundamental analysis on this channel, okay? A lot of the traders that are here understand that you can't just simply look at price. You have to understand the fundamentals of these assets, because what fundamental analysis is, it's the study of price, which is the charts, and value, which is the intrinsic value of the actual asset that you're trading. Okay, so the better we understand the value of the asset, the better we're going to be able to dictate if price is correctly aligned. This is one of the biggest opportunities in 2008 with the Big Short. They saw that the market's price all the way up at those highs in 2008. That wasn't its value. They knew the value of the market was way lower because they understood that the integrity of the market itself was about to fall apart. All right. So at the end of the day, this is why fundamentals are so important. It gives you that perspective as to why assets are priced where they are. And if it doesn't make sense, that is your trade. Okay. So one thing I want to show you guys real quick here is, obviously we took a look at the dollar a little bit earlier. We see that it's spilled just absolutely massively, but I want to kind of head over to trading economics real quick, because if we head over to trading economics and we pull open the USD, one thing I want to show you guys is we'll head over to interest rates and we'll head over to the actual money supply of the US dollar. What you'll notice is there's a very high correlation, inverse correlation, with the dollar and the money supply, okay? That really almost can't be beaten, all right? So this is the amount of actual literal dollars in the US. There are different types of money as it relates to the money supply in different economies. The more developed the economy, the more types of money there are. In the US, there's type O money, type 1, and type 2, and type 3. Long story short, you don't got to understand all the different types as to why they are structured that way, but understand it deals with the liquidity of the market. So type O money is literal cash. So when they printed trillions of dollars during COVID relief, you can literally see all the cash they printed right here on this particular money supply incrementation. All right. And as you go lower, it deals with more hard assets that are a little bit less liquid, but are technically still assets, are technically still cash. All right. Or money considered. All right. So what you want to imagine is every time we saw a massive infusion of capital into the dollar, you ended up seeing an inverse correlation. You ended up seeing the market turn around for a moment. All right. So if we pull back and I'll show you guys here, you see a massive run up. Okay, you see a massive run up here based off of all of the negative things that were happening based off coronavirus. So you see the dollar appreciated dramatically because the dollar is a safe haven currency, right? But what we did not really expect, or many market participants didn't expect, was such a sharp recovery, right? So if we head over to the SPY just real quick, I mean, you guys can literally see that we had this massive spill And then the SPY just ended up rallying all the way back up to the highs, ended up breaking the highs, and you guys know exactly where we are as of now. So when we look at the dollar and we have this massive run to safety, and then subsequently after that, we have this enormous sell-off because of what? Of what reason? Usually when you have mean reversion in an asset, it's because, okay, maybe the data was wrong, or maybe market participants were overzealous and, potentially they bought into a particular trading opportunity or catalyst that maybe reverted back to its mean because it couldn't be substantiated, right? But in this case, it was a little bit more than that, because not only did the risk in markets pretty much go away. Again, this is all perceived risk. Many people think that the market is in massive turmoil, and right now everyone's fighting for $600 or $2,000. So there's obviously some type of struggling happening in the economy in general. Okay, when you look at the jobs report that's coming out on Friday, you're going to notice that the numbers are not good, and you're going to also notice that the unemployment claims are at record levels, all these things. But at the end of the day, the S&P is still at all-time highs. So there's obviously a little bit of irrational behavior happening in some capacity. That's why I always remember that one quote that all traders should know is that markets can remain irrational a lot longer than you can remain solvent. Okay, so at the end of the day, we have to then rationalize that, okay, not only did we get mean reversion here, we're now breaking the low of where coronavirus left off, and subsequently, since where coronavirus left off, we've gone massively lower. So we just have to ask ourselves, okay, how much money did we just print? We just soared past our 2015 highs, because if you guys notice here, if I go to 10 years out, you guys can see that we were actually lowering the deficit in a sense, right? Now, this was the money supply deficit. Basically, we were printing a bunch of treasury bonds and buying them up. Basically, what was happening was the Fed was buying a bunch of treasury bonds from the U.S. government and sending that money into the banks. That's how the first relief happened back in 2008. But we basically stopped allowing those bonds to mature. All right, and we basically just allowed them to go away. So the bonds, they eventually have an end date. So all the bonds that we were buying that were 1 year, 5 year, 10-year bonds or whatever, we were letting them mature, and we weren't basically doing any kind of repurchasing on those bonds. All right, and so that was lowering the amount of capital, literally the amount of money in the entire money supply, which was tightening up the economy a bit. Okay, and this is something that Donald Trump was slightly against. All right, this is something that Donald Trump was fearful of. And if you guys remember back in 2017, 2018, he was talking a lot about, in some capacity, wanting the dollar weak, right? That's all he was talking about. And you can see that reflected in the dollar as well, 100%. You can see that right here. Here you guys go. So look at bad when Trump came into office. Look how much dollar sell side you got. A lot of that was because of Trump rhetoric. We did also have a few hiccups here and there as it relates to CPI and GDP. But overall, you guys can see that things immediately started to restabilize. And our CPI numbers for 2018 were stellar. And that's what drove us to this high. But then after that, we kind of waned off, and we haven't seen too much growth here from the dollar side. Now, as it relates to the S&P, as you guys know, was hitting higher and higher and higher and higher highs. So basically, where does this leave us off? The dollar is just absolutely being smashed. And I believe that this is going to be setting us up for a lot of breakouts that we see happening across all of our currencies. So I have right here on this enormous monitor, I have up all of my dollar crosses. But for you guys, I'll pull it up one by one. So let's take a look simply at just even the Euro USD. Okay, the Euro USD is just massively doing what? Breaking highs. Right? You can see breakout after breakout after breakout. And guess where we're at right now? We're at a potential area where we might see another breakout long here on the dollar. Now remember, all right, there are two components to these currency pairs. There's the dollar. So we now have a pretty solid rationalization after this video. You have a solid rationalization as it might be a good idea to continue to sell the dollar, okay, into all of this perceived U.S. economic growth and U.S. economic strength. I know coronavirus is getting worse and all these things, and it's starting to affect consumer spending a little bit more. Let anything positive come out, it's going to just really hurt the dollar even more, okay? So anyway, yes, we know where the dollar's headed to some extent, okay? We need to see what's happening with the euro. And this is our euro index here. You can see that the euro index has been stutter stepping all over the place. If we get some strength here on the euro, then yes, we're going to get that up move on the euro USD. Now, Draghi, he's somebody that actually wants to kind of stay away a little bit from too much euro strength, and he'll oftentimes come out and, you know, try to talk down the euro, so to speak. So that might hurt you a bit. So where do you want to potentially play that elsewhere? Well, there's a lot of currencies right now that are breaking their all-time highs. The Australian dollar and the New Zealand dollar, they are a part of that pact. Okay, so if we head over and take a look at the Australian dollar index, what do you see? Australian dollar making some serious highs. And if we go to the Aussie D, so the USD AUD, what you guys will notice is, again, it is just doing breakout after breakout after breakout. So basically what I'm saying is, you know, at the end of the day, this might be a solid time to keep an eye on breakouts. I spoke about a breakout opportunity on the dollar just this Friday when I did an end of week recap. And guess what we saw? We saw more dollar pressure sell side, and that's exactly what we're seeing again. So that's pretty much it. If you have a methodology where you can incorporate breakouts in some capacity, then it might work out pretty well. Now, inside of our bootcamp, we trade a lot of mean reversion. So right now, everyone is pretty much altering their strategies to be hitting off on these breakouts. And if you can align to that, then you're going to do phenomenally well. Now, if you're a trend trader and you're waiting for pullbacks, I'll see you in March. You're not going to get any trading opportunities because I'm telling you, these things are just busting out of the highs. Now, whether it's Bitcoin, okay, or whether it's the S&P 500, it seems like everything is ripping highs, and it doesn't seem like we're going to be getting any pullbacks, substantial pullbacks, you know, 20, 30, 40% pullbacks in a little bit. Okay, who knows when it's going to come? But at the end of the day, it just seems like a pretty solid time right now to buy some breakouts. So that's what I'm doing. That's what our team is doing. Okay, if you guys are still confused as to how to navigate fundamentals and look at the market and the technicals in one beautiful picture, then make sure you guys click the link in the bio and head over and take a look at the Top Trader Bootcamp. If you guys have any other questions, comment down below, please. I would love to know what you guys are looking at and what trades you guys are potentially in. It seems like these are going to be some of the most easy money times in FX that we've had in a while, because when market sentiment and trends begin like this, usually that's when everyone wins in some capacity. Okay, so guys, if you need any help, if you have any questions, let me know. My name's Cleveland. Hope to talk to you guys very soon. Peace out.